Hey everyone, last week we got a new inflation reading that was better than expected, and the Federal Reserve raised the overnight rate by 50 basis points. These are good signs for commercial real estate investors. Now I'll start with inflation. The headline Consumer Price Index came in at a year-over-year rate of 7.1%. That, of course, is a really high number. Remember that the Federal Reserve's target inflation rate is 2%. The headline inflation rate appears to be making steady progress in retreating from its peak of 9% set last June. It looks like we're on the back side of the inflation curve. There are numerous forces in play. Oil and gas prices have come down significantly. The prices of raw materials like lumber and steel have also come down. Used car prices are also retreating. They're down 7.8% from their peak in January 2022. We've also seen housing costs relax. Home prices are down 4.4% from their May 2022 peak, while average apartment rents have flattened, perhaps even nudging down by 1% in the fourth quarter. Another favorable trend is emerging in supply chains. They're becoming more stable and more reliable. Importantly, it looks like China will begin to relax its zero COVID policy that has periodically shut down entire cities and major ports. Historically, China has been the leading source of imports to the United States, with about 17% of the total. So the supply of goods is getting better, while the demand for stuff is, at least partially, being curtailed by higher interest rates. Together, that's taking inflation rates lower. But there are several components of the economy that still face upward inflationary pressure. Food costs are up 10.7% compared to last year. That's down from a cyclical peak of 11.4% growth set in August, but it's still really high. And wages are still climbing at a pace of 5.1%, down from their peak of 5.6% set in March 22, but well above the 15-year average of 2.9%. Wage pressure will likely be an ongoing inflationary challenge because of the labor shortage. The unemployment rate is 3.7%, and with about 10 million job openings, we simply lack the labor supply to keep up with demand. I think the labor shortage will continue to drive inflationary pressure, and there's only 3 ways I can think of to fix this. Increased automation, think robot assembly systems and self-service kiosks. Boosting the labor supply through immigration policy changes, or reducing labor demand through a recession. So it looks like inflation is abating, but we're not out of the woods yet. The good news is that it appears the Fed is finally shifting gears. Last week, the Federal Reserve raised the overnight rate by 50 basis points. That's good because the last 4 times the Fed met, they raised the rate by 75 basis points each time. It also suggests they're likely going with a plan they mentioned in November, slowing the rate of increases, then taking a wait-and-see approach. That could mean a 25 basis point rate increase in February and either a 25 basis point move in March or maybe no move at all. That would be really good for the commercial real estate market. It would allow lenders to stabilize rates and reduce capital market uncertainty. Buyers will be able to underwrite assets more effectively, and the expectation gap between buyers and sellers could finally begin to narrow. If inflation continues to come down and the Fed eases back their rate increases, then commercial real estate investor activity could pick up. But remember, you have to look forward 3 to 5 years and consider how commercial real estate will perform on that horizon. There may be opportunities out there today that you can capitalize on if you are looking forward over the longer term cycle. And as always, keep your eyes on the horizon.